Welcome to Talk Tickers, your deep dive into the financial stories moving the markets. Today, we are focusing on, well, just an incredible corporate meltdown at First Brands Group, the private giant that supplies the guts of the automotive aftermarket.
This is a company that, while private, owns products you probably see every day. Things like FRAM filters, Rebestos brakes, Trico wipers.
Yeah, household names?
And FBG is currently navigating a Chapter 11 reorganization, but the numbers are just staggering.
Bring is the right word.
Official liability is over $9 billion, and some external estimates are soaring toward $50 billion.
And all of this is unfolding under the shadow of alleged massive financial fraud and, of course, the resignation of its founder and former CEO.
So our mission today is to really unpack this, the high-stakes launch of FBG's formal asset sale process. We need to understand the mechanics of this auction, what happens when secured lenders get to, write the rule book.
And what this all signals for the $410 billion North American automotive aftermarket.
For you, the listener, this case is really a masterclass in the immense risks that are baked into complex private credit and these off-balance sheet structures.
Okay, so the decisive move here is the launch of this formal sale process for FBG's core automotive aftermarket business.
Right. The goal is to sell the company, either whole or in segments.
A kind of auction.
Exactly. Using Section 363 of the U.S. Bankruptcy Code, which is essentially a streamlined auction aimed at getting the highest or best value.
And the timeline is aggressive, right? They're aiming for a sale completed.
Oh, incredibly aggressive. And court-approved, all in the first quarter of 2026.
What really caught my attention in the filings was the maneuvering that's already happening.
With the ad hoc group of lenders.
Yeah, the existing secured lenders. They aren't just sitting back. They are negotiating to provide additional financing and serve as the, quote, stalking horse bidder.
And that's the critical piece of strategy.
Explain that.
Well, the stalking horse bidder sets the baseline price for the auction. But more importantly, in this case, it gives these lenders immense control.
How so?
They get to write the initial asset purchase agreement, and they're protected with things like breakup fees and expense reimbursements if they get outbid.
So if they're the stalking horse, they define the terms. And because they are existing secured lenders, the company already owes them billions. They can use their debt to credit bid for the assets. They don't have to put up new cash.
Exactly right. They are converting their existing, very risky prepetition debt into the assets themselves.
So this gives the ad hoc group a powerful path to take control of key profitable brands like Centric Parts, Stocktech, and FRAM.
Without having to spend meaningful fresh cash. It effectively locks out other potential buyers who might need to raise that capital.
So let's look at the patient zero of this financial disease. I mean, how did a business with $5 billion in annual net sales in 2024 end up collapsing under this much weight?
Well, the history is pretty telling. FBG was established in 2013 and grew through what I can only call a debt-fueled M&A rampage.
Over 15 acquisitions in less than 15 years.
Yeah, building a portfolio of over 25 iconic brands, including Cardone and Autolite.
The strategy must have sounded good on paper. Maximum efficiency through brand synergies, consolidating warehouses, streamlining supply chains.
It did. But the core issue was just unsustainable leverage. As of the bankruptcy filing in September 2025, FBG was already carrying $6.1 billion in on-balance sheet funded debt.
Which is roughly 5 times the reported 2024 EBITDA of $1.133 billion. That's high for any industry.
Extremely high.
But that $6.1 billion, that was just the official visible debt. And here's where the numbers really jump off the page and the plot thickens.
The off-balance sheet liabilities.
This is the crucial difference between the $9.3 billion in official obligations and those external estimates that run up to $50 billion.
And what's fascinating is how they obscured the debt. They utilized special purpose vehicles, or SPVs.
Things like Viceroy Private Capital, Onset, Carval, and Evolution.
Right. To run around $2.3 billion in off-balance sheet financings. They were using these SPVs to buy and lease back major inventory and equipment.
Essentially hiding debt as complex lease obligations.
It gives the appearance of better financial health than they actually had.
So the SPVs made the debt load opaque. And then you have to factor in another $800 million in unsecured supply chain financing liabilities.
And a staggering $2.3 billion in factoring liabilities, which is cash raised by selling future accounts receivable at a discount.
So you add all that up.
And the official debt obligations are over $9.295 billion, with annual debt service exceeding $900 million. I mean, it was a house of cards just ready to tumble.
And even before the governance crisis exploded, systemic market factors were already dealing some major blows.
Oh, yeah.
Geopolitical uncertainty led to newly imposed tariffs. We saw tariffs as high as 73% on certain parts in April 2025.
And that later just tremendous and unexpected costs onto their operation. FBG spent about $60 million pre-buying inventory to get ahead of the tariffs.
Then still got hit.
And still incurred an additional $99 million in inventory cost increases between April and August 2025.
Wow.
So you couple that with nearly $400 million in upfront cost for integrating all those acquisitions and launching new programs.
No.
Their liquidity was just, well, it was vaporized before the fraud allegations even surfaced.
The company was already strained to the breaking point.
Exactly.
And this brings us to the moment of truth. The governance crisis.
Right.
The liquidity crisis was immediately superseded by the revelation that the former CEO and founder, Patrick James, resigned in October 2025 amid this unfolding accounting scandal.
And this raises that important question. How much of this failure was simply bad market execution, and how much was outright malfeasance?
The allegations are shocking. I mean, I was reading the filings.
They are. The filings indicate that the former CEO may have used erroneous, duplicate, and even fabricated invoices to obtain proceeds through those factoring arrangements.
We're talking about $2.3 billion in proceeds obtained fraudulently.
And specifically, that approximately $1.9 billion in proceeds of factored receivables are completely unaccounted for.
Wait, hold on. You mean almost $2 billion in cash proceeds raised by selling receivables is simply gone?
Gone. That sounds like something straight out of a financial thriller.
It really does.
And that disappearance of cash is what truly terrified the secured lenders and pushed the company into immediate bankruptcy.
Understandably.
The complexity is so severe that FBG's special committee, which is made up of independent directors, is running an independent investigation into all potential claims.
Related to that prepetition factoring and the off-balance sheet financing.
They need to find out where that cash went and, if they can recover any of it. Which immediately shifts the battleground to the investor context. Specifically, the fight over the debtor in possession financing, or DIP financing.
The emergency cash.
Right. FBG needed an emergency cash injection to keep operating. Without it, FBG lawyers warned the court that the company would liquidate.
And it would be game over, cost her 26,000 global jobs.
So they secured a massive $5.2 billion DIP package.
But the details are what caused the huge controversy. The package included $1.1 billion in new money, which is good.
But a staggering $3.3 billion creeping roll-up of existing prepetition term loans.
At a 3-to-1 ratio.
The significance of that 3-to-1 roll-up cannot be overstated.
Let's break that down.
It means that for every $1 of new necessary cash the lenders injected, they got to move $3 of their old, risky, existing debt to the front of the line.
So that old debt, which might have been worthless in liquidation, is now super priority debt, secured against all remaining assets.
It's a massive power grab, leveraging the company's survival against the conversion of their own bad debt into premium collateral.
It was described as off-market and highly contested, especially given the fraud allegations.
Absolutely. The secured lenders sought liens on virtually all of the company's unencumbered assets, including something highly valuable in a fraud case, avoidance actions.
Which are the legal rights of the estate, the company, to claw back payments or transfers made right before the bankruptcy filing.
And those rights traditionally belong to the unsecured creditors.
And the Unsecured Creditors Committee, the UCC, they were not having it.
Not at all.
They forcefully argued that granting the secured creditors those liens was basically a federal foreclosure.
Giving the secured lenders all the recovery rights, while the unsecureds were left with nothing but the burden of investigating the fraud.
And they got some concessions.
They did. The UCC made compelling arguments. The DIP lenders ultimately agreed to increase the budget for the special committee's fraud investigation.
And they extended the challenge period.
Right. They extended the challenge period for creditors to investigate claims against the secured debt until January 31st, 2026.
And that extension is crucial because it gives the UCC time to connect their findings to the new business plan and quality of earnings report, which are also due that same month.
And this whole mess, this opacity, has already caused ripple effects outside of the courtroom. The SEC is now investigating Jefferies Financial Group
over its factoring relationship with FBG through its subsidiary, Point Bonita Capital.
Yeah, what's fascinating here is that the FBG case has really intensified scrutiny on the entire private credit and supply chain finance market. It highlights these systemic concerns about the lack of transparency.
So for now, that $1.1 billion in new DIP money is just focused on maintaining supply continuity.
Exactly. To major customers like Walmart, Advance Auto Parts, and AutoZone, just ensuring those core businesses are preserved for the sale.
The reorganized FBG is going to look completely different, leaner, focused. But getting there is still going to involve years of litigation against the former CEO by a dedicated trust.
This is not financial advice. Any mention of investments or trading is for illustrative purposes only.
Okay.
The market is currently pricing FBG assets at a heavy discount because of all the regulatory and fraud risk. But the core business units, they still retain value.
All right, so here is our outrageous but plausible trade idea based on this distress. We assume the ad hoc group of lenders will prevail and take control of FBG's core assets, Revas, FRAM, Trico,
through that stalking horse and credit bidding process in Q1 2026.
Right. So the new FBG balance sheet will be clean, debt-free, and the new owners will have immediate, massive liquidity from rolling up their old debt.
And that new entity's incentive will be rapid stabilization and expanding its market moat, not slow internal growth.
Exactly. So here's the trade. Long buy, a basket of distressed debt from FBG's biggest competitors.
Specifically, smaller, specialized companies in the high-margin filtration, wiper, or brake segments that might become acquisition targets for the newly recapitalized First brands.
The rationale is simple. The new FBG ownership won't waste time on organic R&D. They will immediately deploy capital externally to reinforce those core product lines by acquiring small, clean, stable competitors.
So buying the debt of those targets now acts as a cheap, speculative hedge on that anticipated consolidation wave. You're expecting the new FBG owner to quickly look for M&A to secure their competitive position in 2026.
So we've taken a deep dive into the First Brands Group Chapter 11 case, covering the launch of the asset sale, the staggering $9 billion plus in official liabilities,
the $1.9 billion in unaccounted for factored receivables that ousted the CEO,
and that highly contested 3-to-1 DIP roll-up.
Yeah, the key takeaway here is just the sheer complexity of untangling structured debt and these contested legal maneuvers.
It signals heightened scrutiny on corporate governance and off-balance sheet financing across the whole automotive sector.
And that fight over the avoidance actions really highlighted the battle lines between secured and unsecured creditors.
So we'll be tracking the key milestones, the business plan due January 31st, 2026, and the formal sale completion target in Q1 2026, as the market waits to see which of these iconic brands survive.
But the essential question you should be watching is this. Given the severity of the fraud allegations and the immense debt load, can the reorganized FBG, even stripped of its controversy, truly secure new financing and compete in the aftermarket sector?
Or will the stain of this collapse permanently restrict its access to the very private capital markets it relied upon for growth?